Right, on to scenario 4. So let's see what happens now. We've set normal capacity at 10,000 units, but we have produced 14. Now let's assume that the 14 is abnormally high. Okay, so we're making that assumption that it is abnormally high, so we can illustrate the provisions of IAS 2. And that particular statement within paragraph 13 says that where we have abnormally high production, the rate of absorption must be decreased so that stock is not valued above original cost. And that's where paragraph 9 comes in, where stock needs to be valued at the lower of cost and naturalizable value. Right, so let's see what happens. Now, we have sold 10,000 units, so therefore production of 14, sales of 10 leaves you with closing inventory of 4,000 units. Okay, and we've left the fixed production overheads to be 650,000 Rand. Okay, so let's see. We've sold 10,000 units, so sales is not a problem. Selling price times 10,000 units. Then there's no opening inventory. So let's have a look at our consistent numbers. Material, we produced 14,000 units times 49 Rand. 14,000 times 775. 14,000 times 25. 14,000 times 10. Now, the fixed overhead. The rate of 63 Rand is a consistent rate times 14,000 units. Now, because we've produced more than normal capacity, we have over-absorbed into the cost of production. Right, and that works out to 882,000 Rand. Now, if we sort of did this side by side, and if we went to the flow of transactions quickly, there we go, there's the flow of transaction, see what happened. Okay, there's your material in the work in progress, there's your labor, variable overhead, and packaging. And look at your overhead control account again. There's the overhead control account. Okay, the actual fixed cost is recorded on the debit side, and then we have the absorbed overhead. Okay, right, and then we're going to take care of the differences between the actual fixed overhead and the absorbed overhead, but we're going to split that into two. So let's go back to our income statement. Right, there's our income statement. Right, how would we value inventory? So let's see. Inventory, all cost incurred to bring the stock to a saleable point must be included in the cost of stock. So let's see. Let's get rid of that quickly. Right, so what will that work out to? That should work out to what we had before, and that is 154 Rand and 75 cents, and there are 4,000 units on hand. So 154.75 times 4,000 units gives me 619,000 Rand. Okay, so look at the consistency in the valuation of inventory within the relevant range. Okay, so if we go down to the value of inventory, so that's on our next slide very quickly. Let's just go there. There we go. 154.75 times 4,000 gives you 619. If we only use the variable cost, which would be 91.75, we get 367. So the valuation of inventory, at this point, obviously, we're simply assuming first in, first out, and generally that's the case, unless the question specifically tells you we're using weighted average. Okay, so let's go down further. Now, we valued inventory, we've brought in the absorbed overhead. Now what we need to deal with is the expenditure and the volume variance. Now, the expenditure variance is the difference between what we thought we would spend and what we physically spend, which is the difference between the 650 and the 630. Okay, and the volume variance is essentially the difference between volumes times the variable or times the fixed overhead absorption rate, which obviously could have been done slightly differently. So if you were to analyze your fixed overhead slightly differently, let's do it like this. That's my actual fixed cost. That's the budgeted fixed cost, and this is the absorbed fixed cost. So let's analyze it in a slightly different manner. So my actual fixed cost was 650,000 Rand, and my budgeted fixed cost was 30,000. The difference between these two gave rise to the 20,000 Rand, which is the expenditure variance, and that was an unfavorable variance. The difference between these two, the absorbed overhead, is the 63 Rand multiplied by the actual production of 14, so that gave us 882,000. So clearly we have over-absorbed by 252,000, so that is a favorable variance because we overutilized our capacity. From a fixed overhead perspective, that's a good thing. Okay, so for the same rent, I made more units than I anticipated. That is a slightly more efficient utilization of your capacity. Okay, so that's another way of analyzing all of that. Or we go back up here, and there's the difference. Now you can see that technically, to understand this in a slightly less technical perspective, let's put it more practically, if I should say, the difference between those two numbers, if you look at it that clearly, okay, is that I've put too much cost in the cost of production, therefore I'm adding the difference back to profit, and that's why that is a positive number. Okay, and then we go down to the usual stuff: variable selling and admin costs, a fixed selling and admin cost, and our fixed production cost. Again, that is the actual cost. Now, the recon's done in the usual way. This is obviously going to be 63 times 4,000. Okay, so 63 times 4,000, just to make sure, 63 times 4 is 252,000 Rand. Okay, now this 252 and that 252, okay, are technically not the same things. This is closing inventory, closing stock, while this is the difference in production between normal capacity and actual production. So it's just coincidence that those two numbers are the same. So don't go and look for a balancing figure anywhere. Those two numbers are not the same things. Right. If we have a look at the flow of transactions now, okay, just to complete that, and then we're going to make one very important adjustment. Right. So as you can see, the fixed overhead expenditure variance is 20,000 Rand. We're going to write that off to something. Okay. And I want you to note the 252. And there's the 252, and that's your volume variance. Okay. Now, paragraph 13 of IAS2 says that where we have abnormally high production, we must not, or what we have to do is actually we're going to decrease the rate so that we don't overvalue inventory. It's not valued above original cost or cost. Okay, so basically what do we have to do now? If we go back to our information, 882,000 Rand was absorbed into the cost of production, and the actual fixed overhead was only 650,000 Rand. Okay, so if I had to use the 882,000 instead of the 650 in valuing inventory, then clearly a lot more overheads have gone into the cost of production. I need to make this adjustment. So if I took the 650,000, which is my actual overhead, and I divided by 14,000, that rate should have only been 46 Rand and 43 cents. But I've used 63 Rand, and therefore, technically, I would have overvalued stock. I have overvalued inventory. Okay, so what I have to do is I'm going to decrease my rate by 16 Rand and 57 cents because currently inventory is overvalued. So if I take my adjusted rate or the adjustment to the rate and I multiply it by 4,000 units, you can't multiply it by 14,000 units, although you've produced 14. You only have 4 left. The rest of the costs have already been written off. The only costs that haven't been written off is the costs that are sitting in the value of inventory. So you cannot adjust everything. You can't take the full 252,000 and make an adjustment for it. The only adjustment you can make is to the closing inventory. So what we're going to do is we're going to drop the value of inventory by 66,280 Rand, which is basically 1657 times 4,000. Okay, and the extract of paragraph 13, in periods of abnormally high production, the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above cost. So what does that mean? I've got to drop the value of inventory. So if you go to your finished goods number now, there's finished goods. Okay, this finished goods value is now adjusted for by 66,280. And look at what we do. We make an adjustment to the volume variance, not the expenditure variance, because expenditure variance is money we've spent. We've actually spent that money. So we're going to make an adjustment to the volume variance there, 66,280 Rand, because your actual overhead was 650 and your absorbed overhead was 882. So an adjustment is required for the value of inventory. So it is imperative, especially with scenario 3 and scenario 4, that you understand that when there is abnormally high production, there's a possible adjustment to the value of inventory. But when there is low production as a result of idle time, we do not make an adjustment to the value of inventory. So in other words, we are not increasing that rate. Now, variable and absorption costing is the crux of cost accounting. So please, you need to go back to the example and you need to be able to do all 4 of these scenarios again without having to look at the solution.